Good day and welcome to our explanation of what is peer-to-peer lending, the risks and rewards. So before we get into it and we explain, give you some examples about how the systems operate and some companies that you can talk to and, how to actually go about it, we should explain the basics. Peer-to-peer lending is simply putting borrowers and lenders together with a very light connection. Historically, what happens is investors, people with money, give money to banks or other financial institutions, and those institutions then lend out that money to various debtors and companies, individuals, whoever. The problem with that is there's a lot of overhead required. What's come out now is something called P2P. So what's being done here is borrowers are talking almost directly to lenders. There will be a website involved that matches borrowers and lenders, and that website will also do the calculations on the credit worthiness of the various borrowers. The idea here really is to get rid of that heavy, fat financial institution in the middle and have it go directly between the lenders and the borrowers, or as close as it can be. So a peer-to-peer lending company, which is really just a website, once again, all they do is they take loan applications, typically from small businesses, although in many countries they also are taken from people. You can lend directly to people, which personally I'm not going to do. I'm just too risk averse to do that. But I will lend money to small businesses. Businesses just have more on the line. So they assign credit worthiness to the borrowers, and then lenders, which are people that are putting money in, the guys that want to get, 10, 12, 15, 20% interest returns, they simply log in, look at each of the requests, and decide if that is what they want to invest in. Although in practice, a lot of people don't do that. And we'll get into the strategy of how you diversify this out in a couple of slides. Most people will set it to auto lend, and that will lend your money out to different companies automatically. Now, the global peer-to-peer market is currently at about $35 billion, and it's expected to hit about $600 billion. So let's call it $500 billion by 2025. So this is a relatively new industry, but it has been around since 2005 when a company in Britain invented it. It's largely what you think of when you hear fintech, one of the fintech technologies. Okay, so why invest in peer-to-peer lending? Well, it's pretty straightforward. The first and the largest reason is, of course, higher returns. And we're going to cover those in just a few minutes here. However, there are other things like diversification of your portfolio. It's a different asset class as well, so you're not talking about typical bonds that are issued by large companies. You're also not talking about stocks. You're talking about something that's just different. So if you want to diversify your portfolio, it's one way to do it. Another nice thing is it's not directly correlated with stocks. The bond market, for instance, is directly correlated with stocks. This is not. That doesn't mean it won't have some impact when the stock market goes up or down, but it means that there's no direct correlation. There's no necessity for one to go up when the other goes down or vice versa. Another nice advantage of peer-to-peer lending is that you are supporting small business, and most likely supporting small business in your geography, or your geography being at least in your country. So you might think, well, why wouldn't I just buy a bond ETF, an exchange-traded fund? Well, bond ETFs don't hold a bond to maturity. What they do is they buy pools of bonds, and what they will do is they will trade them as they go up or down, depending on what the rules of the ETF are. So basically, when you are lending directly, it's less messy than a bond ETF. So the first thing you need to understand when you are dealing with peer-to-peer lending is credit ratings. So this is the typical sort of full chart here. You can see Moody's at the top left. You can see Standard & Poor's, Fitch, so on and so forth. And you can see they have all these complicated ratings, but it boils down to, AAA, they're your prime guys. And if it's not an A grade, it's probably, or a high B, it's a non-investment grade. That's typically the type of investment you're going to end up with peer-to-peer. You're not going to end up with a lot of A's. But this is quite a complex chart, and most people aren't going to want to deal with that. They're just not that sophisticated investors. So this complex chart gets translated down to this usually. Sort of a very straightforward grading system with the interest rates that you can see here range from, this is from 2015 for a particular company, but it really doesn't make much difference. Things haven't changed that much. They range from, 7, 8, 9% up to 25, maybe even 30%, credit card interest rates. And what happens is the peer-to-peer company will take credit information. They'll take an application from somebody that needs to borrow money. And what they will do is they will assign them a credit risk. And they'll grade them here. And they will assign them, based on that grade, they will assign them a particular interest rate. Then they will go to their lenders, people that have put money into the system that want to lend directly to the people that need to borrow money. They will have some small percentages that they will take off in that to make sure that they make a profit. So the company in the middle will make a small profit off each transaction and off each payment. But by and large, this is roughly what you'll end up seeing in payments. So let's get some examples here. This is from LendingLoop in Canada, but it's really not relevant. It's all of the systems that I've seen so far pretty much operate under the same scenario. You can see here that there's a section called for loan details and for business details and financials and so on and so forth. When you're looking to borrow money, you're going to need to provide a lot of this information. If you're looking to lend money to this company, you're going to want to read this information. And you can see down at the bottom left that what they're offering here is a 3-year term, 14, nearly 15% interest. And that's because they were graded as a C plus risk. And they're, in this case, trying to collect about $160,000. You can see in the middle what they want to use it for is inventory. Let's look at another one. So this is another one. You can see this is 3 years. They're graded a little better. They're about 13%. And what do these guys want to use it for? These guys want to use it for advertising. They want to promote themselves. This company wants to raise about $100,000. And they're being offered a 4-year term at about 19% interest. They're not quite as credit worthy as the other guys. And what they want to do with the money, as I recall, is they want to buy some buildings. They want to buy out one of their competitors. Here are some examples from some American offerings. So you can see here, Gain Prosper is offering 36 months, so a 3-year term at 12.5%. Let's look at this in a global scale. So you can see here at the start, this is US. These are all US companies. Then there's Canada with LendingLoop. Then there's the original guys, which is the UK. And now we're hitting India. And there is more India. And then there's the Philippines. And there's Mexico. And we could just continue on and on and on. I put this information up so you can skim through it. If you're from one of these countries, you can at least get yourself familiarized with some of the offerings in your country. And if you're not, just Google them. Okay, so what's the downside to peer-to-peer lending? The downside is that you're lending to companies that typically can't get loans from banks. So that means, again, you're into the non-investment grade guys, you're into the risky guys. That doesn't mean that they're dirt bags. It doesn't mean that they're a bad credit risk. It just means they're not as good as banks would like. Often these are small companies that just don't have the credit history that the banks need. Another big issue here is tax implications. In most jurisdictions, profits that are generated from these payments are taxed as regular income, not as dividend income. And in many countries, dividend income is taxed at half the rate that regular income is. So that's a big issue. The risk. Well, none of these investments are insured like some deposits are, again, depending on your country. It seems that about 10% of these go bad. You're going to have some losses. There's also some fees that need to be paid when these companies go bankrupt or have problems and refuse to pay back. And those fees, however, aren't going to go to you. They're going to go to the middleman company. Basically, at your end, you'll just end up with zero. And you think, well, gee, that's not very good. Well, there's ways to protect yourself, and we'll get into that in a minute. Verification. One of the US companies, and I'm not going to pick on which one because I'm sure if I read them, the documents for all of them, they'd pretty much all say the same thing, which is that they are not required to verify the income or the collateral or whatever else the company that is applying for the loan has provided. They can lend simply on, quote, stated income. So think about the housing bubble where people just claimed they had good jobs when they didn't. They're likely covering their butt, but it's still not very comfortable. Unsecured, yeah, you're an unsecured creditor. So if they go under or refuse to pay, you're probably just out of luck, which we got into risk. Another big item is that they're not liquid. So what that means, liquidity means how difficult is it to change your investment back into cash. And in many places, there are very limited secondary markets to sell these things. So you'll likely have to wait for the 3 to 5 years for that, the loans that you make to pay out. You will not likely be able to go to a secondary market and see if somebody wants to buy them. Now, in Canada, for instance, right now, there is no secondary market at all. That doesn't mean there won't be one in the future. And in fact, I know LendingLoop in particular is working on one, but there isn't anything right now. So you have to look into your market. Even if there is, you're probably not going to want to use it unless you really have to. Again, it's just difficult to get some of the money out, never mind all of the money out. There are also fees for the peer-to-peer services, and they will get their money before you get your money. Something people are really confused with this is that they think they're investing in the peer-to-peer company or the service. You're not. You are lending money directly to a company that is trying to borrow money. And you're simply paying the peer-to-peer service, like LendingLoop or a million other ones, a small fee to cover their costs for setting up the transaction. They're really just a transit point for your money. So who is peer-to-peer lending a bad idea for? Well, it's a bad idea for people that are highly risk averse and people that might need their money quickly. If you need to get your money out in a short period of time because you're a retiree or because you're a student or because whatever, well, this is not the system for you. So back to our examples page, you can see here that the primary reason for people to put their money into these peer-to-peer services is the drastically higher rate of interest that you can receive. And you think to yourself, well, yeah, but there's all of these risks. Why would I do that? It's not as risky as it sounds because what you do is you diversify. So if you take $5,000 and put it into one of these peer-to-peer companies like LendingLoop or Avant or Best Egg or Prosper or whoever else, and then you set up auto lending, what the system will do is it will lend your money out to various companies based on your risk profile. And then your risk profile is just a little questionnaire you'll fill out. But it won't lend out all of your money to one of them. What it will do is it will divide it up. So for instance, I have it set to lend no more than $50 to any company. So that means I will have about 100 loans outstanding. And if 10% of those go bad, well, that's not so bad, right? That's about $500 gone. But when you're making, 12, 13, 14% interest, well, that can certainly compensate for some losses. If you found this video helpful, please click the little like button. It'll help with the YouTube algorithm to raise this video up in rankings. And that's really the nut of it. If you have any questions or concerns, you can ping us at partisanissues.com or leave a comment down below. Thanks for your time and have a great day.